On the evening of July 22, 2026, Alphabet reported its second quarter earnings results. The numbers were extraordinary. Consolidated Alphabet revenues increased 22% to $199 billion. Google Cloud revenues increased 63% to $20 billion. Operating income increased 30%. Operating margin expanded to 36.1%. Search advertising grew 19% year over year. YouTube ads grew 19%. Google Cloud saw a meaningful acceleration in growth. By every traditional measure, this was one of the strongest quarterly earnings reports in Alphabet's history. And then Alphabet's stock fell after hours, despite the beat, despite the 63% cloud growth, despite the record margins. Google stock fell after hours despite a strong quarter as the company's Capex growth announcement spooked investors. At the same time, in the same earnings week, Supermicro shares surged after the AI server maker reported a record backlog. Supermicro, a company that makes servers for AI data centers, the quintessential shovel seller from our video 33, surged while Alphabet, the company actually deploying those servers to generate AI revenue, fell. And Tesla's second quarter deliveries beat estimates at 480,126 vehicles, a record quarter, but investors are focused on the company's Capex commitments to Optimus and full self-driving, not on the delivery numbers. What is happening? Why does beating earnings cause your stock to fall? Why does the company building AI infrastructure surge while the company generating AI revenue falls? And what does this mean for every investor who has been watching the AI boom with either excitement or anxiety? Today, I'm answering these questions, using the most important framework for understanding why great companies make decisions that markets temporarily punish. That framework comes from a book called Loonshots by Safi Bahcall. Welcome to Earnings Per Page. Honest finance, no hype. Hit subscribe. Let's get into it. Part 1. The Alphabet Paradox. Precisely what happened. Let me be exact about the numbers because the paradox is in the details. Alphabet's Q1 2026 free cash flow fell 47% year over year to $10.1 billion as capital expenditure accelerated. Now in Q2 2026, the same pattern is continuing. Alphabet is generating extraordinary revenue, $109.9 billion, up 22%. It's generating extraordinary operating income, margin of 36.1%. But its free cash flow is shrinking because it's spending at an extraordinary rate on AI infrastructure, data centers, custom chips, network capacity, research. CFO Anat Ashkenazi said Alphabet expects to convert more than half of its $462 billion Google Cloud backlog to revenue over the next 24 months. Read that again. Alphabet has $462 billion in committed Google Cloud contracts. It expects to convert more than half, over $231 billion, to revenue within 2 years. This is an extraordinary number. It's the strongest possible validation that AI-driven cloud demand is real, committed, and large, and yet investors punish the stock after hours. Why? Because converting $462 billion of backlog into revenue over 24 months requires massive ongoing capital expenditure, data centers, chips, cooling systems, power contracts. And markets are asking one specific question. What if the AI revenue arrives more slowly than the Capex? What if the $462 billion backlog takes 3 years instead of 2? What if hyperscaler clients reduce their commitments as the AI deployment cycle proves more complex than projected? The IBM pattern from Video 41, the Netflix pattern from Video 41. These are exactly the scenarios that make investors nervous when a company announces accelerating Capex alongside record backlog. Part 2. What Bahcall's Loonshots framework explains. Safi Bahcall published Loonshots in 2019. It's one of the most original business books of the decade, a genuinely fresh framework for understanding why organizations succeed or fail at innovation. Bahcall's central concept is the phase transition. He borrows from physics to describe how organizations shift between two states. State 1, the Loonshot nursery, an environment where crazy, ambitious, high-risk ideas are nurtured, experimented with, and allowed to fail and iterate. This is where breakthroughs happen. State 2, the franchise phase, an environment optimized for scaling and protecting what already works. This is where profits are maximized. The danger Bahcall identifies, and it's directly relevant to Alphabet today, is that organizations in the franchise phase systematically kill Loonshots. They optimize for near-term returns. They cut experiments that don't deliver immediately measurable value. They make rational short-term decisions that destroy long-term competitive position. Now apply this to Wall Street's reaction to Alphabet's earnings. Markets are in franchise phase thinking. They want current free cash flow. They want near-term capital efficiency. They want the AI investment to convert to profit quickly. Alphabet's management is in Loonshot phase thinking. They see a $462 billion committed backlog. They see Google Cloud growing at 63%. They see a generational opportunity to dominate enterprise AI computing. They are choosing to invest aggressively now to capture that opportunity rather than optimize for current quarter free cash flow. Who is right? Bahcall's framework says both at different time horizons. The franchise phase investors who punished Alphabet's stock after hours are correct that near-term free cash flow is under pressure. The Loonshot phase management team at Alphabet is correct that investing now would cede the AI cloud market to AWS and Azure. The tension between these two correct positions is exactly what the after-hours stock drop represents. Part 3. Supermicro surges. The shovel sellers win again. Supermicro shares surged after the AI server maker reported a record backlog. We identified this pattern in video 33, the AI gold rush, and the shovel sellers. Supermicro makes the physical servers that house NVIDIA's GPUs inside AI data centers. It's the pick and shovel play. It benefits from AI infrastructure spending regardless of which AI application or AI model wins. Supermicro surging while Alphabet falls is the clearest possible real-world confirmation of the video 33 framework. The gold miners, companies trying to extract value from AI, are under Capex pressure. The shovel sellers, companies supplying the infrastructure regardless of outcome, are winning clean. This matters practically for investors. If you are invested in the S&P 500 index fund from video 38, you own both Alphabet and Supermicro. You're exposed to the Capex pressure risk and the shovel seller upside simultaneously. But if you're choosing specific AI exposure, the Supermicro pattern confirms that infrastructure supply is still the most durable position in the current phase of the AI cycle. Part 4. Tesla, the automation bet that markets don't know how to price. Tesla's Q2 deliveries beat estimates at 481,26 vehicles, a record quarter. Tesla's earnings are forecast to have grown by 25% from the year-earlier period. But Tesla shares have fallen after 3 of the company's last 4 earnings releases, including an 8.2% drop on mixed Q2 2025 results. The Tesla earnings story in Q2 2026 is not about cars. It's about 2 things. First, Cybercab, Tesla's robotaxi program. Low implied Cybercab output suggests more delays in ramping up robotaxis. If Cybercab timelines are pushed back again, the premium valuation Tesla carries over a normal automaker evaporates. Tesla isn't priced as a car company. It's priced as an AI and automation company. If the AI and automation timeline keeps slipping, the stock's premium over fundamental automotive value contracts. Second, Optimus, Tesla's humanoid robot program. Elon Musk has said Optimus could eventually be worth more than the entire rest of Tesla combined. Markets haven't priced this in because it's too speculative to model, but they also haven't priced it out, which means Tesla carries a significant option value premium that depends on Optimus delivering. The Q2 earnings call language around Optimus deployment timelines will be as important as the actual vehicle delivery numbers. Bahcall's Loonshot framework applies directly to Tesla. The company is simultaneously managing a large, profitable franchise business, car manufacturing, and nurturing multiple Loonshots, Cybercab, Optimus, FSD monetization. The danger is franchise phase pressure killing Loonshot investment. So far, Musk has maintained the Loonshot culture at Tesla despite enormous pressure from short sellers, analysts, and quarterly earnings cycles. Whether that continues in 2026 is the key long-term question. Part 5. The broader earnings season context. 88% of companies are beating. Of the roughly 50 S&P 500 companies that have reported, 88% have exceeded analyst earnings expectations. Analysts estimate the year-over-year S&P 500 earnings growth rate for the second quarter will be 24.7%, above the 5-year average of 16.4% and the 10-year average of 10.3%. This is a strong earnings season by any historical standard, and yet markets aren't responding with enthusiasm. The S&P 500 slipped 0.14% on Wednesday despite 2 major beats. Why? Because the market is priced for perfection and beyond. The S&P 500's forward price to earnings ratio was at 21.3 times on June 30, a 7.5% premium relative to its 10-year average. When you're priced at 21.3 times forward earnings for 24.7% EPS growth, beating earnings by a normal amount isn't enough. You need to beat A&D, guide higher A&D, show expanding margins A&D, show free cash flow strength. Alphabet did 3 of 4. The Capex growth killed the free cash flow narrative. Markets punished accordingly. This is the context for understanding what 88% earnings beat rates actually mean when the market is priced at premium multiples. Beating is the price of admission. Beating decisively and showing capital efficiency is what actually moves stocks higher at these valuations. Part 6. What the Iran connection adds to this week's story. This is where Video 44 and Video 45 connect. The Iran peace deal collapse that we covered in Video 44 is applying pressure on this earnings week in 2 specific ways. First, oil prices are elevated. The attack near the waterway reaffirmed the fragility of the US and Iran's interim peace agreement. Higher oil prices mean higher energy costs for AI data centers, a direct margin pressure on Alphabet, Amazon, Microsoft, and every other hyperscaler building massive AI infrastructure. The $462 billion Google Cloud backlog is denominated in dollars. The cost of powering those data centers is not immune to oil price spikes. Second, geopolitical uncertainty is suppressing market multiples. Investors facing genuine uncertainty about Iran, about oil, about inflation re-acceleration, about the Fed's rate path, demand a higher risk premium. A higher risk premium means lower valuations for the same earnings. This is why beating earnings isn't enough. The environmental uncertainty is too high for markets to reward even strong results with stock appreciation. Part 7. What to actually do. The Bahcall informed framework. Here's the honest, practical section. The Loonshots framework suggests 3 specific things for investors navigating the AI earnings paradox. First, separate franchise businesses from Loonshot businesses in your analysis. Alphabet's search and YouTube advertising are franchise businesses, generating reliable, growing revenue with high margins. Alphabet's AI infrastructure build is a Loonshot, high risk, high potential reward, currently consuming free cash flow. Don't punish the franchise because the Loonshot is expensive. Second, the Capex to revenue lag is not a crisis. It's a feature of every major technology transition. The railroad boom of the 1870s destroyed capital for years before generating economic returns. The internet infrastructure build-out of the 1990s consumed capital for a decade before the revenue materialized. AI's Capex to revenue lag is measured in quarters, not decades. Alphabet's $462 billion backlog converting to revenue within 24 months is a timeline that makes the capital expenditure rational. Third, maintain your shovel seller exposure alongside your AI application exposure. Supermicro's surge while Alphabet fell is a reminder that the most reliable AI trade is still infrastructure supply, not AI application revenue generation. Both are valid. The portfolio that owns both is more resilient than one that has made a concentrated bet on AI applications delivering immediately. Final verdict on Loonshots. Should you read it in the context of the Alphabet earnings paradox? Absolutely yes. Bahcall's framework is the best available explanation for why Alphabet's management is rational to spend aggressively on AI infrastructure, even when markets punish the Capex. And it's the best available explanation for why investors are rational to be nervous about free cash flow, even when revenue is growing at 22%. My rating, 9 out of 10. Genuinely original thinking, occasionally oversimplified in the historical examples. But the phase transition framework is one of the most useful mental models for understanding innovation investment decisions. The honest bottom line for July 22nd, 2026. Alphabet beat earnings and its stock fell. Supermicro reported a record backlog and surged. Tesla delivered a record quarter, and markets are waiting for the AI timeline to hold. The AI earnings season is doing exactly what this channel predicted across 43 episodes, separating the shovel sellers from the gold miners, revealing the Capex to revenue lag as the central tension of the AI boom, and showing that beating earnings at 21.3 times forward multiples requires extraordinary execution, not just solid performance. If this connected the dots from everything we've been building, subscribe to Earnings per Page. Drop a comment with whether you think Alphabet's AI Capex is rational long-term investment or risky overextension. See you in the next one.